Welcome to another FAR walkthrough video from Superfast CPA. I'm Logan, and in today's video we're going to be going over FAR Area 1, B3, and this is an application topic. Prepare a statement of cash flows and required disclosures using the direct method or indirect method for a non-governmental not-for-profit entity. And we're going to be doing that the Superfast CPA way, which is diving straight into questions. If you don't know much about our strategies, the main idea behind Superfast CPA is using the questions as your main learning material. Instead of watching hours of lectures and reading through a big textbook, most of your time is spent in going through the multiple choice questions and the sims, because that's what you're going to be doing on test day. So if you want to learn more about that, make sure you go check out our free 1-hour webinar training on superfastcpa.com. Again, it's only 1 hour and it's free, and we will teach you the key ingredients to passing the CPA exam. So make sure you go check that out. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in today's video, whereas Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. All right, here we are at question 1, and something that we always like to point out with the Superfast CPA strategy is one of the best strategies is to immediately go to the end of the question, the last line, to see what the actual question is so that you can get context for the rest of the question so you know what you're looking for as you read through it. So first, let's read this. When preparing the statement of cash flows, how should the entity classify the cash inflows from these donations? So we need to know how to classify these inflows that we're about to look at. So let's go back up. A non-governmental not-for-profit entity received several cash donations during the year, some with specific donor restrictions. The following donations were made. So there was donation A, that was $200,000 restricted for the purchase of a new building. Donation B, that was a $50,000 restricted for the purchase of investment securities to be held in an endowment fund. There was donation C, which was $100,000 restricted for operating expenses over the next 3 years. And then finally, donation D, $75,000 that was unrestricted to be used at the organization's discretion. So I am assuming that you've watched some of the previous videos, or if you haven't, this might be a little bit confusing because we've talked a lot in the previous videos about nonprofit organizations and the different things like with or without donor restrictions. So if you haven't watched those, this might be a little bit confusing. But with that said, which of these is going to be included as an operating, an investing, or a financing activity in this statement of cash flows for this nonprofit organization? So go ahead and pause the video if you want to kind of read through that again and read through the different options. But when you're ready, we'll look at the answer together to kind of dive into maybe some of the differences that can happen with a statement of cash flows for a nonprofit organization versus a for-profit organization. So I'll wait for you. When you're ready, come back. All right, here we are at the answer. The answer is D. Donation A was a financing activity, donation B was a financing activity, donation C as an operating activity, and donation D as an operating activity. So let's walk through this. We're going to get some reminders on what typically goes into financing, operating, investing activities, and such. For a non-governmental not-for-profit entity, contributions that are restricted by donors for long-term asset purposes, such as purchasing property, equipment, or investments like securities, are classified as financing activities on the statement of cash flows. Now, I just want to say, if you've seen the previous video or if you know anything about the statement of cash flows for a for-profit entity, that might seem a little strange because when you think of long-term assets, property, plant, and equipment, you typically think of investing activities when you think of the statement of cash flows. But when it comes to the statement of cash flows for a nonprofit entity, those things, if it's money from a restricted donation for those things, then it would be a financing activity. So let's dive in a little bit more. This classification applies because these contributions impact the entity's net assets. Because if you think about it, again, it's a donation with donor restriction, which is something that impacts the net assets of a company. And if you remember, net assets is basically the equity of a nonprofit organization, and financing activities cover long-term liabilities and equity, or in this case, net assets. So again, going to this classification applies because these contributions impact the entity's net assets, or basically the equity, which is why it's a financing activity. The same treatment applies whether the restricted funds are used for the acquisition of long-term assets, like property, or investments that are intended to be held long-term, such as in an endowment fund. So even though these amounts are something that's restricted for something that you would consider an investing activity, like buying property or buying an investment, because it's affecting net assets with donor restriction, it's actually a financing activity. So now we look at the donations. Donation A, that's $200,000 restricted for the purchase of a new building. So even though buying a new building would be an investing activity, receiving the money and having it restricted for that it's affecting the net assets, so it's classified as a financing activity. Same thing with this donation B, $50,000 restricted for the purchase of investment securities for an endowment fund is classified as a financing activity because it affects the long-term financial structure of the entity, similar to how donations for property purchases are treated. So similar thing, it's a long-term asset, but you haven't actually bought the long-term asset yet. This is just money you received that's restricted to buy that. It's affecting the net assets of the company, so that's going to be a financing activity. I know that might be a little bit strange just because you might be used to a for-profit entity, but that's how it works in a nonprofit entity. Donation C, $100,000 restricted for operating expenses. So even though it's restricted, I'm not saying that all restricted funds are financing activities. I'm saying that if you receive restricted funds that are specifically for purchasing a long-term asset, that would be for financing activities. But for operating expenses, just normal expenses of the company, even though it's restricted for that, it's going to be used in the short term, in the near future, so it's going to be still classified as an operating activity. And then this makes sense, donation D, $75,000 unrestricted. It's unrestricted, they can use it how they want, and they're going to be using it for general operations, so that one is also for operating activities. So big thing you need to learn from this is that even though the funds are restricted for something that you would think is an investing activity, because it's affecting net assets of the company, which again, for nonprofits is technically equity, that is going to be a financing activity, not an investing activity. Let's go to the next question. All right, here we are at question 2. A non-governmental not-for-profit museum had the following transactions during the year. The museum purchased a painting for $500,000 to add to its permanent collection. Later in the same year, the museum sold the same painting for $750,000 with the proceeds intended to be used for future art acquisitions. How should the museum classify these transactions on its statement of cash flows? So they paid money for this and then they received money for selling it. How is this going to affect the cash flow statement? Is it going to all count as operating activities, all count as investing activities? Is the purchase an investing activity and the sale a financing activity? Is the purchase an operating activity and the sale an investing activity? If you don't know, that's okay. Think about what you know about investing activities and financing activities and operating activities, and when you're ready to come back, we'll look at the answer together. All right, the answer is B. Both the purchase and the sale are going to count as investing activities. So let's read through this. Important. So this is kind of something important, something you need to know. Proceeds from the sale of works of art or purchases of works of art or, collections or things like that are investing activities. So that, it should make sense because you're buying a long-term, a long-lived asset that's going to bring money to the company because people are going to go look at it and pay money to go look at it. But just making sure you know, proceeds from the sale of works of art or buying works of art is an investing activity. So let's walk through this. The purchase of the painting for $500,000 is classified as an investing activity because it involves the acquisition of a long-term asset, the work of art, for the museum's collection. Again, that should kind of make sense when you think about what the work of art is going to be used for. The sale of the painting for $750,000 is also classified as an investing activity because it involves the disposal of a long-term asset from the museum's collection. The use of proceeds for future art acquisition does not change the classification. So that doesn't really matter what they're going to use the funds for. The fact that they got funds for selling a long-term asset means it's an investing activity. Both the purchase and sale of works of art are considered investing activities on the statement of cash flows. Okay, now one more note I want to make. You may not see this very much or at all, but there is a small chance that you might see this. But for works of art or collections, any insurance recoveries related to lost, stolen, or destroyed items from these collections should be classified as investing activities on the statement of cash flows. So again, it makes sense because it has to do with those long-term assets that are a part of investing activities. But just in case you ever see this or you ever have a thought about this, if works of art or collections, which again are long-term assets that have to do with investing activities, if those are lost, stolen, or destroyed, any insurance proceeds, like you get money for insurance for the item, that's also going to be an investing activity in the statement of cash flows. And with that, let's go to the next question. All right, here we are at question 3, and I didn't do this in the last question, I just realized, but we're going to do it in this one. Before we do anything else, we're going to read the bottom question. How much should be reported in investing activities in the statement of cash flows for the year if the company uses the indirect method? Okay, so we're looking at so we need to know how much they're going to be reporting in investing activities using the indirect method. So let's read through the rest of this. A non-governmental not-for-profit entity recorded the following transactions during the year. They used all the money from a $300,000 cash donation received in a previous year that was restricted by the donor for the purchase of a new building to purchase a new building. So again, just to reiterate that, they used money that they received that was restricted to purchase a new building, they used that same money to purchase a new building. So they used it for what it was for, but it was restricted money originally. They sold an investment security for $200,000 that had originally been purchased for $180,000, and they recognized a $20,000 gain on the sale. They paid $50,000 to acquire a new work of art for the entity's collection. They paid off $100,000 in debt that had been used to finance the construction of a new facility. And they received $150,000 in cash from the sale of a piece of equipment originally purchased for $100,000 with a resulting gain of $50,000. So with all of that, again, we already kind of read this, what is going to be reported as investing activities from all of these transactions. Now, we've talked a little bit about these different things. We've talked about investing activities so far. And again, you might have seen previous videos where I talked about the statement of cash flows, and we also talked about some investing activity rules here. So go ahead and pause the video, think about this, do the calculation yourself, and when you're ready, come back, we'll look at it together. All right, here we are at the answer. The answer is actually $0. That's the ending change in investing activities. So let's talk about this. Important. This is another important rule or note or however you want to say it. Though contributions received with restrictions to be used for the purchase of long-term assets, such as a new building, are considered a financing activity inflow. So again, we talked about if you receive a contribution that has a donor restriction to be used for something specific like purchasing a long-term asset like a building, that is a financing activity inflow. But when that money is used to purchase the long-term asset, so when it's used for what it's supposed to be used for, which is purchasing a long-term asset, this is still considered an investing activity cash outflow. So it was considered a financing activity cash inflow, but now that it's being used to purchase a long-term asset, it is still considered an investing cash outflow. So that might have been something you were thinking about. Is it going to count as a financing outflow? Is it always a financing activity when it comes to the cash from these restricted donations? And it only counts as a financing activity inflow, but when the money's used, it's still an investing cash outflow. So I just wanted to make sure that's clear. So that means that the $300,000 spent to purchase the new building is an investing outflow, even though the cash was used from a contribution that was originally recorded as a financing activity. So that's some clarification there. The sale of the investment security for $200,000 is an investing activity because it involved the sale of the asset. The acquisition of the work of art for $50,000 is also an investing activity as it involves the purchase of a long-term asset. We talked about that. The sale of the piece of equipment for $150,000 is an investing activity because it involves the disposal of a long-term asset. So finally, these transactions together, $200,000 from the sale of the investment, less $50,000 for the purchase of the work of art, plus $150,000 from the sale of equipment, less the $300,000 from the purchase of the new building. If you add that all up, $200,000 less $50,000, that's $150,000, plus $150,000, that's $300,000, less $300,000 gets you to $0 in investing activities based off of the things that we were given here. The $20,000 gain on the sale of the investment security and the $50,000 gain on the sale of the equipment are reported as part of the operating activities, not investing activities. And if you remember, it did mention we were using the indirect method here. So that's why those would be considered a part of operating activities. We're going to talk about that here in the next question, actually. But these were the things that affected the investing activities. Let's go to the next question. All right, here we are at question 4. And before we dive into the whole question, let's go to the bottom to know what we're looking for here. Using the indirect method, so we know we're using the indirect method. How much will operating activities increase or decrease for the year? Okay, now with that information, we can go to the top. They have the following information. There was change in net assets, $150,000. Depreciation expense, $40,000. Gain on the sale of equipment, $25,000. Increase in contributions receivable, $30,000. Decrease in accounts payable, $15,000. Donation received with donor restriction for a new building, $200,000. Proceeds from the sale of equipment, $60,000. So with all that information and using the indirect method, how much is the operating activities going to increase or decrease throughout the year? Now, again, if you've seen some stuff like this before, it's just the statement of cash flows. It's very similar for a nonprofit compared to a for-profit, very similar. We've already talked about some of the major differences. So with that, if you know how to do this, go ahead and pause the video and do the calculation yourself. If you're not really familiar with this, that's okay. Pause the video if you want. If not, let's go to the answer. All right, here is the answer. The answer is A. It was an increase of $120,000. So let's walk through this. To determine the net increase or decrease in operating activities using the indirect method, you start with the change in net assets, which, by the way, is basically net income for a nonprofit organization, and then adjust for non-cash items and changes in working capital. Items that are classified as financing or investing activities obviously should not be included here. So We start with the change in net assets from statement of activities. And again, if you've seen this before, it's very similar. We've been over this in other videos, so we're going to talk about it a little bit here. Start with change in net assets. That's basically net income. So that's $150,000. You add back non-cash expenses because depreciation expense, while it decreases the change in net assets, it isn't actually a cash transaction. So you add it back because no cash was actually used there. Same with these gains and losses. You add back a gain because it artificially, as far as cash is concerned, increased the income. So you subtract that to make it accurate again. And then you also adjust for changes in working capital. The contributions receivable, that increased, meaning that instead of actually receiving the cash, people are just saying they're going to give you the money, but you haven't actually received the cash yet. So that increased net income when you haven't actually received the cash, so you subtract that. And then with accounts payable, if accounts payable went down, that means you paid off some of your debt. So that means you used cash to pay that off. So that's $15,000 that decreases it. So overall, the net increase in operating activities is the beginning change in net assets, $150,000, plus the depreciation expense, less the gain on the sale of the equipment, less the increase in the contributions receivable, less the decrease in accounts receivable, giving you $120,000 increase in operating activities. And again, that's using the indirect method. Of course, you don't include the financing or the investing activities. The donation for the new building, that's a financing activity, and the proceeds from the sale of equipment is an investing activity. So this was kind of a refresher on how the indirect method works for the statement of cash flows. It's very similar to how you do it for a for-profit entity. Now let's go to the last question. All right, here we are at question 5. A non-governmental, not-for-profit organization provided the following cash receipts and payments during the year. So before we go any further, let's read the last part. Using the direct method, how much should be reported as net cash provided by or used in operating activities for the year? Okay, so this is talking about the direct method. Now, we have not talked about the direct method so far in any of our previous videos because specifically for the statement of cash flows for for-profit entities, you are not going to be tested on the direct method for those entities. So again, I want to make that clear. For for-profit entities, you do not have to know how to do the direct method for the statement of cash flows. You only need to know how to do the indirect method. However, for nonprofit organizations, you may need to know how to do the direct method because it does say that specifically in the blueprint title. So now let's read the rest of this. They had the following receipts and payments during the year. So there was change in net assets of $200,000. Cash received from donors for unrestricted purposes, $300,000. Cash received from program service fees, $150,000. Cash paid to employees for salaries, $200,000. Cash paid to suppliers for program expenses, $100,000. Cash received from the sale of an investment, $80,000. Cash paid for rent and utilities, $50,000. Cash received from a restricted donation for equipment purchase, $250,000. So a whole bunch of information there. Again, how do you use the direct method to calculate the net increase or decrease in operating activities for the year? If you've never really dealt with the direct method, it's actually pretty easy. It's a little bit easier than the indirect method, but again, you're less likely to be tested on the CPA exam. But we're going to go over this question. If you know how to do this, go ahead and pause the video and come back when you're ready. If not, let's go ahead and go straight to the answer. All right, here we are at the answer. The answer is A, $100,000. So let's walk through this. To calculate the net cash provided by or used in operating activities using the direct method, you should focus on the actual cash transaction related to operations and ignore the change in net assets. So I just want to say that one more time. When it comes to the direct method, you don't need to worry about the net income or the change in net assets. That is not a part of this calculation. It's actually pretty straightforward. You just include the cash received from donors for unrestricted purposes, cash received from program service fees, cash paid to employees for salaries, cash paid to suppliers for program expenses, cash paid for rent and utilities. Basically anything that's operating, the things that are not investing or financing. You're not buying long-term assets, you're not receiving or paying off long-term debt, or you're not changing the equity of the company, or in this case, the net assets of the company. It's just normal expenses and normal receipts of cash. That's what you add up all together for the operating activities when you're using the direct method. So in this case, you would not include the sale of the investment, and you would not include anything that was restricted for the equipment purchase because that would be a financing activity. So you just add it all up, the $300,000 received from donors, the $150,000 from program service fees, less the $200,000 cash paid to employees, less the $100,000 cash paid to suppliers, less the cash paid for rent and utilities. All that together is $100,000 increase in the statement of cash flow operating activities. So again, I just want to clarify, when it comes to the direct method, if you see anything about change in net assets, that's a red herring. That's meant to distract. You don't actually need that for the direct method when you're doing the statement of cash flows for a nonprofit entity. And with that, we've learned a lot in just 5 questions. We learned especially a lot about the differences when it comes to the statement of cash flows for a nonprofit entity. Before we go any further, let's do one more part of the Superfast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is, as you're going through the questions to learn the material, you will notice the things that keep popping up, the key points, the pillar topics, the things that your review course is obviously trying to teach you. You know, you've seen 3 questions trying to teach you how works of art are included in investing activities, or you've seen 4 questions trying to teach you that those contributions with donor restrictions to purchase long-term assets aren't investing activities, but they're actually financing activities, and things like that. You notice those things, you write them down as pillar topics in your own words so you know them for later. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics, and again, it's kind of a summary of the key points, the most important things that you learned from the questions. So first off, the indirect method for not-profit organizations. The indirect method starts with the change in net assets, which is basically the income, the net income, and adjusts for non-cash items like depreciation, gains, and losses, as well as changes in working capital to calculate net cash provided by or used in operating activities. Again, very similar to a for-profit organization in that regard. The direct method, which you won't be tested on for a for-profit organization, but you may be tested on for not-for-profit organizations. This reports actual cash transactions related to operating activities, such as cash received from donors, all the same things, but you don't do any adjustments for non-cash items or working capital changes. Next, as far as the classification of restricted donations, cash inflows from donor restricted contributions for long-term purposes like purchasing property or investments are classified as financing activities in the statement of cash flows, while the actual purchase of long-term assets is classified as an investing activity. And then finally, for works of art transactions in not-for-profit organizations, transactions involving the purchase of or sale of works of art are classified as investing activities in the statement of cash flows. This also includes insurance reimbursements for lost or stolen works of art or collections. And with that, those are the pillar topics for this video. We only went over 5 questions in this video, but remember that Superfast CPA members will have access to the rest of the video where I go over another 5 questions so you can get more practice. So if you like going through these questions with me, you can become a Superfast CPA member to get more. Also, make sure you go check out our free 1-hour webinar training on superfastcpa.com. Again, we will teach you the key ingredients to passing the CPA exam. We will teach you things like studying in the morning, only having to study 2 hours during the morning, and then you study throughout the rest of the day with mini sessions. And we have audio notes and review notes, and there's a lot of things that you can learn when you go to superfastcpa.com. Make sure you go check it out and make sure you watch that webinar. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.